Hello, I'd like to welcome you to our video entitled Purchasing Power at a Lower Tax Bracket, where I'll show you how things can look in retirement from a financial perspective. Now, here's what we'll cover today in today's video. We'll review how inflation affects your purchasing power throughout retirement, and look at how your retirement will look like at a lower tax bracket. And we'll review how inflation can be combated during retirement. And finally, we'll discuss how you can be at a lower tax bracket without sacrificing your income. Now, let's begin with this question. Is inflation real? I mean, let's consider how prices have risen since the 80s and 90s. It's not hard to see if we look at it this way. Whether it's gasoline, homes, vehicles, or even the price of hockey sticks, it's very easy to see how things have become more expensive over a long period of time. Imagine spending $300 on a high end hockey stick back in the 80s. I mean, you would never consider that, right? It's understandable that inflation is not at the forefront of our minds because it's so slow moving. We often only see the effects of inflation over the span of decades instead of days. It's kind of like watching your lawn for an hour and concluding that it isn't growing and that you won't need to mow it come the weekend. Unfortunately, inflation is as real as your grass growing, and we need to have a strategy to deal with it. Now, enough of this subjective speculation, and let's look at some real hard data. Here's the average inflation rates over the last 70 years, as reported by Statistics Canada. As we can see, it's a bumpy ride. Up until the the early 90s, we can see that there's a high amount of volatility in inflation, and from one year to the next, you'd be hard pressed to try to estimate or guess where the inflation will end up in the next year. But we see since 1992 that inflation has been relatively under control from too much volatility. This is because of the adoption of explicit inflation targets starting in 1991 by the Bank of Canada. As you can see by the middle gray line in the 7-year is the 7-year average here, and it was if you this the 7-year average, if you look at all the years on this graph, averages out at about 3.55% inflation. But since 1992, this yellow line is actually the average inflation that we have seen since that time, since the early 90s. And since the early 90s, we're now at a 1.78% average inflation rate, which is just under 2%. In fact, the Bank of Canada's target inflation rate has been about 2% in its monetary policy. And as you can see, it's been very successful at holding this target since the early 90s. Now, to quickly recap, since 1992, the Bank of Canada has set inflationary targets to be 2% annually and uses its monetary policy authority to achieve this target. And since 1992, the Bank of Canada has been pretty successful in achieving this, since we've seen an average inflation rate of 1.7% annum since then. Now, we have to remember that inflation does not directly factor the cost of energy or food. The reason for this is because these commodities are highly volatile due to extreme weather events or geopolitical instability. Rather, inflation is based on the price of a whole suite of other things that we use in everyday life, which inevitably require food and or energy to produce, because all these goods and services are delivered by people who eat and by many forms of energy, whether it's gasoline, diesel, or other forms of electricity. Now, based on this data, that's why I assume a 2.5% average inflation for planning purposes. Now, with the 2.5% inflation rate, let's take a look at how your purchasing power will react over time. If we take $100,000 of today's dollars, of 2019 dollars, and look 10 years in the future, in 2029, then it will only be able to purchase $78,000 worth of similar goods and services than it could purchase today. And similarly, if we look at the same $100,000 today, today's 2019 dollars, and use it 20 years in the future in 2039, then it will be worth about $61,000. And finally, again, taking that same $100,000 today, stretching out to 30 years in the future, it's worth less than half of its value today in terms of purchasing power. So it's very important to see that because inflation is so constant throughout a lifetime, that it does have a cumulative effect as we start looking at the long term. So it is a force to be reckoned with for sure here. Now at retirement, let's take a sidestep here for a moment and take a look at what changes here at retirement. Well, a couple of things change. Obviously, if we retired and we're no longer working, and we're drawing a pension, then at this point in time, well, our CPP premiums stop and our EI premiums stop because we don't have to pay those anymore. And presumably, your incomes will decrease as well, maybe. And it really depends on your lifestyle. It depends on your goals and your dreams, what you want to do in retirement. And but what typically doesn't change, and what we've seen because of the data, is that inflation continues. So that's a force that continues to be reckoned with going forward here. Now, let's take a look at our tax system here in Canada and Alberta. We have a progressive tax systems in both Canada and Alberta, and this means that the tax rate increases our taxable income. Our tax rate increases as our taxable income increases. In this graph, you'll see the actual 2019 tax rates, brackets, and credits. The left side of the graph shows the federal tax credit brackets. So we can see here the federal tax brackets here on the left-hand side. We start for the first $47,000 that's earned in your income is taxed at 15% on the federal side. The next $47,000 that's earned is taxed at 20.5%, and the next $52,000 that's earned is taxed at 26% on the federal side, and so forth. As there are further tax brackets north of there, but we'll just show the first three for illustration purposes only. And on the provincial side, we have the first $131,000 that's earned is taxed at 10%, and the next $26,000 that's earned is taxed at 12%. And there are a few more tax brackets north of there, but we'll just stop at these two for illustration purposes, right? And we have also, with our tax brackets, we also have non-refundable tax credits. These are nearly universal non-refundable tax credits. So we have the Canada Employment Amount, which is basically a tax credit that's given to anybody with a salary or is drawing a pension income. And so this is a small tax credit that will give you back 180 for the 2019 limit, assuming that you earn or have an income greater than this amount. You will get back $183 in your tax return. And you also have a federal basic personal amount of $12,000. And this is applied at your 15%, your basic tax bracket on the federal side, which nets you a return of $1,810. And you have your provincial basic personal amount as well, which is nearly $20,000 in Alberta. And again, that's applied at the basic tax bracket for Alberta, which nets you um, a net return of nearly $2,000 here. So that's your tax brackets and your basic non-refundable tax credits. Now, with that, I'd like to talk about a couple of definitions here. Number one is the marginal tax rate. And this is probably the definition of tax that you've seen, that you've heard about many times already. So whether we're talking about what's your tax rate at, and then you'll likely be quoting this definition, or well, if somebody's asking you what tax bracket you're at, they're really asking you about what's your marginal tax rate, right? But the technical definition of the marginal tax rate is it's the tax rate incurred on each additional dollar of income. So what we mean by that is, like, let's say assume that throughout the year you've earned $100,000, okay? And on December 31st of that year, you earned an extra dollar. Well, the question is, if we're asking the question, what is that extra dollar going to be taxed at? We're asking the question, what is the marginal tax rate of that extra dollar? So if we look at our chart here, we can see we have $100,000 of income, and that extra dollar on the federal side would be taxed at 26%, and that extra dollar on the provincial side would be taxed at 10%, meaning that their marginal tax rate would be 36%, the sum of the two provincial and federal rates at that level. Now, again, let's assume here that we have $80,000 of income that has been accumulated on December 31st, and then we make an extra dollar on that last day of the year, and we ask what's that marginal tax rate of that extra dollar? Well, that marginal tax rate on the federal side would be 20.5% plus the 10% from the provincial side, meaning your marginal tax rate would be 30.5%. Now, that's all good, but there is actually another tax rate definition that is actually a little bit more useful when we're actually trying to just compare more apples to apples here, and that's the effective tax rate or the average tax rate. And quite simply saying, it's the average rate that an individual's overall income is taxed at. So if you take all your tax expenses, and that includes deducting the non-refundable tax credits, and you divide it by your taxable income, then that's going to give you the average amount of tax that you're going to pay on every single dollar of income for that year. Now let's look at some scenarios here to show what we mean here. So let's look at income at $125,000, at income at $100,000, and an income at $75,000. So if we look at it, we have at $125,000, we have a marginal tax rate of 36%. But the effective tax rate, if you actually calculate all the taxes that we pay on the federal side, all the taxes that we pay on the provincial side, deduct the non-refundable tax credits, we're going to see here that that effective tax rate is only sitting at about 26.6%. And again, if we have an income of $100,000 and we have again, the marginal tax rate will be the same here. It'll be sitting at 36%. But the effective tax rate, though the marginal tax rate is the same thing, the effective tax rate is actually a little bit lower. It's at 24.2%. So we see basically a 2.4% drop in average tax rate from earning $125,000 to earning $100,000. And then again, there would be, if we look at dropping at $75,000 of income, the marginal tax rate now you're at the lower quote unquote tax bracket. You're at 30.5%, and your effective tax rate is at 21.8%. So despite the fact that we dropped the marginal tax rate by 4.5%, our effective tax rate has only budged about 2.4%. So it's important to understand this, and I generally go through this with clients because there's a notion out there that people believe that once we cross some kind of threshold of income, that there's just going to be a huge explosion or a huge savings in taxes. And as we can see here from if you just look at the percentages, the average percent of tax that is being paid, it's not leaps and bounds. It certainly is lower, but we're not getting into the leaps and bounds. So I don't like to paint people an overly rosy picture. I don't like to paint an overall doom and gloom picture. I just simply want to paint the actual picture that the data draws. So this is, at the end of the day, what we generally conclude from this here is that you're going to pay less tax in retirement. Let's say if you drop your income from $125,000 to $100,000, you will pay less tax, but it's simply just because you're getting less income and you're going to get less taxes. The tax rate is almost proportional, is almost the same, whether you're making $125,000 or $100,000. It's just the fact that you're getting less. You're getting $25,000 less of income. That's going to cause your tax burden to drop here. And I'll show you a little bit more data on this as we go forward.
Now, what about CPP and EI premiums? Well, let's look at an example here where we have a person who's working as an employee in 1 year, and at the end of the year, on the first day of the following year, goes as fully retired. So in 2019, the person worked as an employee until December 31st, and then as of January 1st, the person was fully retired. Now, we're going to assume here that they're going to go from the person who, while working, was contributing the maximum CPP and EI premiums according to the 2019 limits. So that means that they contributed in premiums for CPP by $2,748, and they contributed $860 of EI premiums during that whole year. Those are the maximum for 2019. Now, if they did that, basically we have to remember that the CPP and EI premiums are federal and provincial non-refundable tax credits. So ultimately that means that they will be returned 25% of those premiums at tax return time. So their tax credits on the provincial side, federal side, that adds up at 25% in Alberta for a premium return at tax return time. And then we have to look at it that when they're fully retired, when they transition from working to being fully retired, it doesn't result in all the premiums coming back because some of the premiums already came back in the form of tax credits, but it does result in a 75% net reduction of when premiums were paid. So that for the 2019 numbers at least would result in a net savings of $2,786 of premiums that no longer have to be paid once in retirement. And again, that's assuming that once in retirement, there is no employment. It is just strictly drawing from different pension sources to provide retirement income.
Now let's go back to our tax bracket discussion here, and and just look at this summary here. And again, this summary is largely based on the slide that we saw 2 slides ago here. That the gross income. So we have gross income, whether we're looking at $125,000, $100,000, or 75, or $50,000. Here's the average tax rate that you're going to pay, right? So these are the same numbers we looked at before in our example. And what we see here is that there is actually, as you get a little bit lower, once you dip around the $50,000 mark of income, you're going to see the percentage of taxes paid drop substantially. And that's mostly because those non-refundable tax credits do get more amplified as you get lower and lower and lower income. And again, marginal tax rate. This is what you would have to pay in marginal tax rates. And total taxes, again, if you look at the difference here, what would have to be paid in these scenarios here. So you get total taxes amount here. And this is just taking into account the basic tax credits. Your situation might be different because of different tax credits you could take advantage of. But just a very general scenario here. In here, if you make $125,000, you can expect to pay roughly $33,000. And if you drop $25,000 of income, well, that means you're going to drop roughly $9,000 worth of taxes. So again, it's almost proportional, right? Again, here, if you drop another $25,000 of income, you're going to see a drop of roughly $8,000 of income. Again, very somewhat proportional here. And then we start seeing a little bit more dramatic changes as we drop lower than that. So again, just to reiterate, you know, if you have less income, you're going to pay less taxes, but it's not going to be super dramatic. But at the end of the day, what if you could pay less tax without sacrificing much or any income? And that's one of the key questions I really want to get into now that you've seen the backstory here. And I want to show you an example. Let's look at the sample retirement income composition, where on the one side, option one, money would be coming from a RIF. So we'll have some money coming in from a registered retirement income fund, which is, what usually will be converted from. This will originate from an RSP when you get into when you retire, and you have RSP money that typically converts into a registered retirement income fund. You can do other things with it, but this is the most popular option. And then you draw income from that money, and we'll also get some CPP. We'll get some OAS, Old Age Security. CPP stands for Canada Pension Plan, and we might get a work pension, and of course have to pay some income tax, right? So in option one, we're going to assume that this is our sources of income in retirement, which we can see here that this is the amount of income tax that would have to be paid here, and we'll have to pay about $26,750 of income tax, giving us a net income of $79,800. Now, let's just assume here for a moment that we switched up our income composition. Rather, if things were planned ahead of time, rather than having a RIF, we had a TFSA from which we were drawing an income from for retirement. And we saw in the previous video, if you remember watching, we saw how that could be done. So now we're having $40,000 of dollars from the TFSA. There's no RIF money, obviously, in this scenario. CPP, we're going to get some money from CPP, same amount as before. Now here with the oil age security, there's a difference. So why is that? And I'm going to get to that, and I'm going to get to that in a second. And we can see the work pension, same thing, but the taxes are substantially lower. Now let's start there. Now the taxes are lower because when on option one, the taxes you're paying taxes on all four of these items. All four of these items are considered taxable as income, so you have to pay a large amount of tax on that. Versus here, the $40,000 of TFSA withdrawal is actually tax-free, obviously. So you're only paying tax on a much smaller portion of your income. And actually, this is really the only thing that's actually considered taxable income. So there you go. The other benefit in this particular scenario, and this may not apply to everybody, but in this scenario it applies, is that you have an issue of old age security clawback. So once you make over $75,000 a year in income, um, some of your old age security benefit is clawed back. Every dollar you make over $75,000, 15 cents of that will be clawed from your old age security. For every one of those dollars is clawed back here. And so our old age security benefit is actually lower. Here, the benefit, obviously, we're getting the full benefit, assuming we take the age 65 old age security option. And so again, here, so this at the end of the day, if we consider we're paying less tax and we've got a old age security that's not clawed back, this nets a difference of about a 20% higher net income coming in at the end of the day. So again, this is again how um, uh, if things are planned out carefully, how it can net benefit you quite a bit more coming into retirement. You have less of a tax burden. You have less of a tax burden to deal with, and in some cases, you may even qualify for certain better qualify for certain government programs like old age security. And again, this difference here, dovetailing back to our inflation problem, this difference here can be used to help combat. It can't combat the whole thing, but it can be used to help combat a good chunk of the inflation problem. So all of a sudden here, it's not about, we often say our investments have to outpace inflation, and that's true. But there's other tools in the toolbox that you could use to help fight inflation. And this is one of those strategies that is less talked about, but is just as relevant and needs to be part of the equation when you're looking at inflation. And I'd like to thank you again for watching this video. I hope this short video was value added for you. And if you have questions or would like to book a free consultation, you can contact me via email or schedule a strategy session by clicking on the link or button below.